It is Wednesday, January 21st, 2026. And if you've been brave enough to look at your trading terminal or your 401k login in the last 24 hours, you might be feeling a little, well, let's call it motion sick.
Motion sick is a polite way to put it. I think nauseous is probably more accurate for a lot of traders right now. The markets are staring down what the analysts in our source stack are calling a monster.
And they really aren't being subtle with the imagery today. I was reading through the research notes, and one of them literally compares this market turbulence to Ghidra. For those who aren't caught up in their kaiju lore, that is the three-headed dragon that fights Godzilla.
It sounds dramatic, I know. But it's actually a surprisingly fitting metaphor for what we're seeing. Usually when the market takes a hit, it's one big thing, a bad jobs report, a bank failure.
Sure.
But today, we're seeing three distinct high-voltage shocks hitting the global financial system all at once.
Yeah.
It really is like a coordinated attack.
Okay, so our mission for this deep dive is to untangle these three heads so we don't get eaten by them. We've got a historic meltdown in the Japanese bond market. That's head number one.
Right.
We have a geopolitical tussle over, and I still can't believe we're talking about this, Greenland. That's head number two.
And head number three is a very strange, very alarming signal coming from the precious metals market. It's the kind of signal that suggests the smart money is starting to question the validity of, well, government currency itself.
But then it's all this chaos. There's this weird calm in the oil markets. So we need to connect these dots. We have to figure out how a snap election in Tokyo, a real estate deal in the Arctic, and the price of gas at your local pump are all somehow part of the same story.
And the so what here is fascinating. It really comes down to one word, affordability. We are seeing a shift in global politics where the cost of living affordability is becoming the ultimate constraint on world leaders.
It's like a leash.
It is a leash. It stops them from doing what they might otherwise want to do.
Affordability as a geopolitical leash. I like that framing. All right, let's confront the first head of the monster, the roar from Tokyo. What exactly happened in Japan yesterday?
History happened. We saw a massive sell-off in Japanese government bonds, or JGBs. Now, usually the JGB market is known as the widowmaker because people bet against it and lose. But generally, it's about as exciting as watching paint dry.
Right, very stable.
Very stable. Yesterday, it wasn't.
Give us the numbers.
The yield on the 30-year bond, and this is specifically for issuances that have been around since the year 2000, had its biggest daily leap on record.
The biggest daily leap in over 25 years, that's not a fluctuation, that's a break in the pattern.
Exactly. And the 10-year yield, which is the benchmark for borrowing costs across the entire Japanese economy, it shot up above 2.3%. We haven't seen levels like that since 1999.
Okay, I want to pause here. Because we have listeners from all backgrounds, some are day traders, some are just trying to understand the world. Why does a yield spike in Tokyo matter to someone sitting in, say, New York or London? Why should you care if Japanese rates go up?
Great question. It matters because for the last 2 decades, Japan has been the world's financial anchor. They kept interest rates at rock bottom, sometimes even negative.
Right.
That meant Japan was a source of incredibly cheap cash. Investors would borrow yen for practically nothing and use it to buy stocks in the U.S. or bonds in Europe or, emerging market debt. It's called the carry trade.
It's the liquidity engine for the global market.
Right. Japan has been exporting cash to the rest of the world. But when Japanese yields spike like this, that dynamic reverses. It's like someone turned on a giant vacuum cleaner. Suddenly, it makes sense to keep that money in Japan to earn that higher yield.
And it sucks that liquidity out of everywhere else.
It threatens to, yeah, and that destabilizes everything.
So the anchor's dragging, and the ship is starting to drift. But why now? I mean, this didn't just happen in a vacuum. What was the trigger?
It's entirely made in Japan. It's a political crisis. Prime Minister Sanae Takaichi has decided to roll the dice. She's called a snap election for February 8th.
A snap election.
Yeah.
Always a risky move for a prime minister.
Extremely risky. Look at her position. She's charismatic. She's personally popular. But her political situation is, it's fragile. Her former coalition partners just merged with the main opposition party.
So she's facing a united front.
Exactly. She needs a mandate. So she's playing the populist card. She is proposing to completely eliminate the consumption tax on food.
Which, let's be honest, to the average voter walking through the supermarket in Tokyo, that sounds fantastic. Cheaper groceries. Who votes against that?
Nobody votes against it at the ballot box.
Yeah.
But the bond market votes with its capital. And the bond market looked at that proposal and just freaked out. You have to remember, Japan already has a massive debt load, the highest debt to GDP ratio in the developed world.
So if you cut that tax revenue without cutting spending, you are
You're
just...
blowing a massive hole in the
Love that.
budget. Precisely. And the bond market is saying, we don't think you can pay for this. We're hearing the term bond vigilantes being thrown around in the analysis again.
I haven't heard that term in a while. It sounds like a Western from the 90s.
It's an old school term for sure. It refers to investors who sell off a country's bonds to punish the government for fiscal irresponsibility. By selling the bonds, they force the interest rate up, which makes it more expensive for the government to borrow.
It's the market basically saying, stop it, behave.
That's it.
This feels incredibly similar to the UK situation a few years back. The whole Liz Truss moment.
That is the exact comparison the analysts in our source material are making. Remember when British Prime Minister Liz Truss tried to push through unfunded tax cuts?
Vividly, yeah.
The bond market revolted, the pound tanked, mortgage rates in the UK skyrocketed. She was out of office in weeks.
Yeah?
The fear right now is that Takeuchi is walking Japan right into that same trap.
Trying to buy votes with tax cuts, and the market is threatening to break the economy in response.
That's the narrative. But you sent me a note from Jesper Cole, and anyone who follows Japan knows he is the ultimate Japan optimist. He sees this differently, doesn't he?
He does, and it's a really important counter-perspective to keep us balanced. Cole argues that we are misinterpreting the signal. He says this isn't a crisis, it's normalization.
Normalization. 2.3% yields feels like a crisis to the traders who've gotten used to zero.
Well, look at the fundamentals. Japan finally has positive inflation. It has real economic growth. In a normal, healthy economy with those stats, interest rates should be what, 3–4%?
Between 3.5 and 4%, yeah.
So in his view, 2.3% is actually still too low?
Precisely. Cole thinks the market is just waking up from a 20-year nap. He believes the Bank of Japan is going to have to hike rates repeatedly over the next 2 years just to catch up to reality. So this isn't the sky falling.
It's the sky moving back to where it's supposed to be.
That's his take.
That is a comforting thought, that this is just growing pains. But there's one piece of data that doesn't quite fit the healthy normalization story, and that's the currency.
The yen.
Yeah. Economics 101 says if a country's interest rates go up, their currency gets stronger, right? Because that higher yield attracts foreign money.
Correct. That's the textbook mechanism. Higher rates equals stronger currency.
But the yen isn't rising.
No, it's not. And that is the mystery. If this were a healthy move, the yen should be soaring. It would be blowing up that carry trade we talked about. We saw a preview of that in the summer of 2024, and it was ugly.
Not now.
But right now, the carry trade seems to be holding on. The yen isn't spiking.
Which implies the market is looking at Japan and seeing risk, not strength.
Yeah.
They don't trust the currency even with higher yields.
Exactly. It's a vote of no confidence. It suggests that investors think the debt problem is bigger than the yield benefit.
Okay, so that's the first head of the monster. Tokyo bonds are screaming, and the currency is acting weird. Let's pivot to the second head. And this one. I admit I had to double-check the data in the article. We are talking about Greenland.
We are, and I know, it sounds like a headline from a satire site or a flashback to 2019, but this is a major market driver in 2026. This is about the diplomatic fallout from the United States' continued efforts to acquire Greenland from Denmark.
I thought we moved past this years ago, but clearly not.
It's back, and it has escalated significantly. President Trump has threatened tariffs on European nations that oppose the U.S. acquisition.
Tariffs, the magic word that makes markets twitch.
Instant jitteriness, and we saw the reaction immediately spill into U.S. markets. The uncertainty drove the 10-year U.S. Treasury yield to a 5-month high. Stocks took a hit, too. The S&P 500 dropped over 2% yesterday.
Now, the source material notes that some of that drop was just the market playing catch-up after the MLK Day holiday, right?
Yeah, that's true. There was some backlog clearing. But look at Europe. The Stoxx 600 was down nearly 1.9%. This was a synchronized global risk-off day. But here's the fascinating nuance. If you compare this reaction to last year.
You mean Liberation Day? April 2025.
Right. When the tariffs were announced back then, what the traders call Liberation Day, inflation expectations went through the roof. Everyone thought tariffs mean higher import prices, which means inflation is back.
That makes sense. Tariffs are taxes on consumers, essentially.
But this time, crickets. The market is not pricing in a long-term inflation spike. It's really weird. It's like the market is treating this as a weak echo of last year.
So they're selling stocks because they don't like the uncertainty, But they aren't actually betting that the tariffs will stick or cause real inflation.
It seems that way. It's almost like a boy who cried wolf scenario. The market is seeing the headline, reacting reflexively by selling riskier assets, but deep down, the bond market isn't convinced that a massive inflationary wave is actually coming.
Or, and here's the darker possibility, maybe they aren't worried about inflation because they're worried about something much worse, which brings us to the third head of the monster.
The flight from fiat.
This was the signal that really stood out to me in the notes, because usually when there is chaos abroad like in Japan, money flows to the safe haven.
Right, to the US dollar.
The dollar is the ultimate safety blanket. When the world catches fire, you buy dollars. That's the rule.
But that didn't happen yesterday. Japan's bonds were selling off, Europe was down, and the dollar fell too. It had its worst day since August 2025. So if the money didn't go to the dollar, where did it go?
It went to the rocks. Precious metals.
Gold, silver, platinum.
The Bloomberg Index for precious metals, which tracks a basket of these commodities, is currently sitting at levels we haven't seen since 1980.
1980.
Yes. And you have to understand the context of 1980 to get why that is so scary.
1980 was stagflation. It was a miserable time for the economy, high unemployment, high inflation.
It was a crisis of confidence. People weren't buying gold in 1980 because they liked jewelry or because they thought tech companies needed silver for circuit boards. They were buying it because they thought the dollar was going to be worthless.
They were hedging it against out-of-control inflation and a total loss of faith in government institutions.
But we aren't in stagflation now. The U.S. economy is growing. GDP is positive. Unemployment is relatively low.
That's what makes this signal so spooky. To see a massive rally in precious metals like this, right in the middle of a growing economy, it suggests that something is, quote, seriously amiss in the plumbing.
So investors were looking at U.S. debt, Japan's debt, and they're just decided they don't trust government paper money anymore.
I'd rather hold a rock than your promise to pay. That's the sentiment. And that is stark. It's a vote of no confidence in the system itself.
Okay, so let's recap the monster so far. We have bond chaos in Tokyo, driven by populist tax cuts. We have tariff threats over Greenland, shaking up equities. And we have a quiet but powerful exit from the U.S. dollar into gold. You would think, looking at those three things, that the whole world was on fire.
And yet, look at the energy market.
The calm eye of the storm.
It's bizarre. We have significant geopolitical shocks involving Venezuela. We have serious tension in Iran. Remember, the U.S. dropped a bunker buster bomb on Iranian nuclear facilities just last summer.
And there are protests in the streets of Tehran right now.
Exactly. Historically, any one of those headlines would send oil to 100, maybe 150 a barrel.
Oh, easily. Panic buying would set in.
Yeah.
But prices are stable. In fact, Brent crude actually tumbled recently.
Why? Is the world just using less oil, or is this that affordability theme coming back?
It's a mix of supply and politics. First, the supply side is real. Excess global oil supply is at multi-decade highs. There's just a lot of oil sloshing around, which put the cap on prices.
But the political side is where the affordability doctrine really kicks in.
Explain the affordability doctrine.
It's the idea that political survival now depends entirely on the price at the pump. Take the situation in Iran. President Trump briefly mused about intervening in the Iranian protests supporting the uprising against the regime, but he stopped very quickly.
Because intervention creates instability, instability raises oil prices, and high gas prices lose elections.
Precisely. Washington has realized that American heroism abroad could carry a political cost at home, and that cost is unacceptable.
So pragmatism wins. You don't get involved in foreign conflicts if it's going to raise the price of a gallon of unleaded in Ohio.
We are in the era of affordability-first politics. Think about the U.S. housing market. The administration has been working incredibly hard to lower mortgage rates. They even announced a massive $200 billion bond buyback to manipulate rates down. But the chaos in Japan and the Greenland jitters are pushing U.S. rates back up. They are fighting the market to keep costs low for voters. They cannot afford an oil shock on top of that. It's a delicate balancing act. They need calm to keep living costs down. But the report mentions one massive tail risk, the one thing that could wreck this whole affordability strategy.
The Strait of Hormuz.
The choke point.
Yeah. Oxford Economics ran a scenario on this. They're assigning a 10% probability to a situation where U.S. military action leads Iran to disrupt the strait.
And for those who don't have a map in their head, just how vital is that strait?
It's the jugular vein of the oil world. About $1 billion worth of oil passes through there. every single day.
X.
If that gets shut down or even significantly disrupted, the analysis suggests global GDP growth could be cut by zero point 0.4 percentage points. Inflation could jump by nearly a full percentage point.
That's the recession trigger right there. That's a nightmare scenario.
It is. Shipping volumes could plunge 80% for a month. It would be a supply chain disaster. And that is why the oil market is watching so closely. Right now, the market is betting that Trump and other leaders are simply too afraid of the voter backlash to let that happen. They're betting on pragmatism.
Yeah.
The monster is actually being held back by the voters' wallets.
In a way, yes. Takaichi in Japan wants to cut taxes to help voters with food prices. Trump wants to buy Greenland but won't touch Iran because of gas prices. The common thread is that politicians are terrified of the cost of living.
It's fascinating. We usually think of geopolitics as this grand game of chess played by ideologies, but right now it feels more like they're just trying to keep the grocery bill down so they don't get voted out.
That's the reality. But here is the danger. The financial markets, the bond vigilantes in Tokyo, the gold bugs buying bullion, they aren't voting. They're moving capital. And right now, they are signaling that this focus on short-term affordability might be creating long-term instability.
Because you can't just print money or cut taxes forever to keep people happy. Eventually, the bill comes due.
And that 30-year bond yield in Japan, that wasn't just a number on a screen. That was the bill coming due.
Okay, let's synthesize this for everyone listening. We've got a three-headed monster. Tokyo bonds are screaming that debt matters and that the old easy money anchor is gone. Greenland and tariffs are showing us that international alliances are fragile. And precious metals are telling us that trust in money itself is shaking.
And yet, oil remains calm, essentially subsidized by leaders who are forced to prioritize affordability above all else. It's a very strange, very tense equilibrium.
So what's the takeaway here? If you're sitting at your desk watching these charts, what should you be thinking?
I think you should be watching the tension between political ambition and economic reality. Whether it's Takaichi or Trump, leaders are constrained. They can roar like Godzilla, but the bond market and the gas pump are the ultimate gatekeepers.
It's a battle between what they want to do and what the market will let them do.
Precisely. And the fact that precious metals are rallying like it's 1980, that suggests the market thinks the politicians might lose control.
That's a sobering thought to end on. The market is betting that pragmatism will win because voters demand cheap goods and low rates. But if those bond vigilantes in Tokyo keep pushing, and if gold keeps climbing,
then we might be seeing the cracks in the era of government control over the economy. The market might be about to take the wheel.
which is a ride I'm not sure I want to be on. We'll be watching closely. Thanks for diving in with us today.
Stay safe out there.